Hello and welcome to the SC Insights webinar for today, lithium batteries and the year ahead. Little bit of housekeeping. The slides and a recording will be made available after the presentation. And there's also an anonymous Q&A function, so please feel free to ask questions throughout and we'll try and get to them all at the end. So, quick introduction to SE Insights for those not familiar. We are an independent research and consultancy focused on the lithium-ion battery supply chain. Primarily, we focus on due diligence and asset valuation across the supply chain. We also do a huge amount of commercial advisory, advising people on term sheets and take or pay offtake contracts, as well as input to pre-feasibility studies, 43101 reports, and full bankable feasibility studies. So moving on to the topics for today. At the beginning of the year, we put out a press release looking at the 5 things to watch during 2025, and we've got those listed up here. Just going to talk through them relatively briefly, and then I'll give a bit of an opinion as to what's changed already from those 5 things. First one, looking at the geopolitics of it all. It's pretty unsurprising to everybody that the supply chain remains in oversupply for pretty much every stage of it. In lithium, we continue to be in oversupply. Prices are relatively depressed, albeit high by historic standards. A lot of that's down to cost inflation, though, in the production of lithium. And effectively, we don't see that changing until probably the end of 2026. That's when we see the market going into quite a big deficit position. So 2025 likely to be a little bit more pain in the supply chain, but lots and lots happening in the interim. I think in particular, what you're seeing is this disconnect between China and the rest of the world. So China's pushed all of the supply chain into oversupply, but we're still in undersupply in North America, we're in undersupply in Europe. And if we don't want to have this huge burden of Chinese supply dominating the market, then governments still need to be very active in promoting domestic supply chains. That's something that isn't new. It's not going to change. I think in the current US administration, we will see a couple of changes in approach, but ultimately it won't be a big deal for the market versus where we were at the end of last year. Looking at the supply-demand balance, as you said, still in oversupply on the lithium side of the market. That said, we will have stocking and restocking cycles. I think we are forecasting the price to actually increase relatively significantly from the annual averages last year. We're predicting an annual average of 12,650 for lithium carbonate CIF Asia this year. But even if we do see price increases, it's going to be very difficult to get over a sort of $15,000 per ton LCE level. And the reason for that is there's still plenty of supply built up. There's plenty of stockpiles in the supply chain. And ultimately, if you want to buy a cargo of spodumene or you want to buy a cargo of lithium carbonate, there's still plenty of people who will sell it to you. There's also quite a bit of locked-in capacity. We've seen slowdowns in ramp-ups of new supply, and ultimately that's going to keep a cap on prices for the next year or so. So no massive change there. The one thing that we see, which is quite worrying for the market, is while near-term production seems to be carrying on, so a lot of people believing in the market and where there's capital committed, a lot of new projects are still coming online. The projects that the market really needs for 2028, 2029 are just not happening at the moment. They're not moving forward. A lot of the junior miners are leaving the market, pivoting to back to uranium or precious metals or more interesting markets of the day. and it's setting us up for a huge deficit towards the end of the decade. And it's really quite worrying um, when you sort of calculate the numbers and you look at this. It's we're going to have the mother of all deficits towards the end of the decade when it comes to lithium. So yeah, boom and bust cycle continuing. Looking at the cost curve and long-term prices, still seeing quite a bit of cost inflation. One of the interesting things we're seeing is, particularly on the refining side, a lot of the refining assets which are coming on stream are not managing the throughput that they predicted they would have. And if you can imagine a refinery that was predicting to have costs of $5,000 per ton, and it's only doing half of what it imagined, then its costs are going up to $10,000 per ton. And that's a real worry again for any refining capacity outside of China. And again, we think that's going to put quite a bit of pressure onto lithium chemical prices in the medium and long term. Looking at the competitive players, obviously, there's been quite a bit of corporate news, particularly with Rio Tinto's bid and ongoing takeover of Arcadium. We do see a bit of consolidation in the market, um, partly because of junior players dropping out, but also I think we're starting to see some more capitalized companies coming in and taking a bigger position within the lithium market. Jose, I'm going to pass over to you just to see if you've got any comments on the five things.
No, absolutely. I couldn't agree more. You've said it all. Just to mention briefly that one of the key reasons for the lack of price rebound in 2025 and most likely the first half of 2026 is the capacity of response that China has. It used to be in terms of well, obviously everybody monitors the inventories, but nowadays it's becoming more and more complex. We're gonna speak about that. One thing that worries me personally a lot is the decoupling of the cost increase of projects versus the stagnating dynamics of pricing. Pricing is still kept under the $10,000 per metric ton threshold, while costs continue to increase between players across countries and in the industry, in the mining industry in general. That doesn't mean that for us this year it's not going to bring big surprises in terms of M&A. I think that for the first time, and I finished with this idea, the evaluation of the projects are consistently dropping, finally dropping after the ludicrous price cycle of 21 and 22. Back to you, Andy.
So, with all of that, it's pretty easy to say, lithium's just like every other metal market out there. There's nothing special about it. It's an oversupply, it goes to undersupply, and we have these boom bust cycles. But it's really important to remember that lithium is actually still quite a special market. There are no proxies to it out there. And the reason for that is we still have a very robust demand growth in the market. And, lithium demand grew, close to 20% last year. You wouldn't believe that. Looking at the price, looking at what's happened in the industry, looking at the negative press that you see, even looking at all the negative press about EV adoption. But the fact is, we still are going to see double-digit demand growth in this market for the next couple of decades, and there's nothing that's changed from that scenario. The current situation is completely unsustainable when we look at prices versus costs, and certainly the incentive price to bring new production to the market. And I quite often come back to this slide, and I know I've shown it before, but it just sort of shows the position we're in. That believe it or not, between 2019 and 2023, the average price for carbonate was close to $30,000 per ton, and we added just over 500,000 tons of new supply. We need to add 1 million tons, and at the moment the price is around 10. It's very difficult for people to double production if they're not making any money. It's very difficult for people to double production if they are struggling to repay their debts. It's very difficult for people to get into production if their projects don't make money at the current spot price. And that's a position, as you'll see when we look at the cost curve a bit later, that the market is in at the moment. So it is completely unsustainable from where we are. The longer this goes on, the more people will sort of become sort of naysayers in the market. I've seen it in other markets. It will pass. The question is when the market starts to rebalance. So yeah, very difficult position at the moment. And that's something we see across the supply chain. So here we're looking at the sort of average margins across the different stages of the supply chain. We separate it into three stages. So we've got extraction, refining, cathode or electrode production, the battery itself, and then the end use. And what we're seeing at the moment is current operating margins for extraction, quite often negative. A lot of the cost curve is not making money on the spodumene side at the moment. Also, on the brine or concentrated brine side. When we look at refining, again, margins across the board incredibly low, particularly on the Chinese refining sector. And again, we'll look at that in a bit more detail later on. The refiners are really struggling. And one of the interesting things actually about the refining sector is if you go back a year or 18 months, everybody was talking about this huge wave of Chinese lepidolite, which was going to come into the market and completely blow everything away. Now, the issue we have at the moment is the refineries are not going to process lepidolite if they have an option to buy spodumene because they can process spodumene cheaper. They can maintain more of a margin processing spodumene. Quite often, lepidolite or low-grade lepidolite will damage those refineries more than the spodumene processing will. So it will lead to higher maintenance costs. And what we're seeing is actually the growth in Chinese lepidolite is really quite limited. The big surprises on the supply side have been from African supply, particularly from Zimbabwe. We think that will slow down in terms of the ramp up over the course of this year, just because the pricing of that material at the moment very much dependent upon byproduct credits. And indeed, those byproduct markets themselves, looking at niobium, looking at tantalum, they're not doing particularly well either. So I think there we're going to see a little bit of a slowdown. But again, you're in overcapacity on a global basis on the refining side. Cathode, again, huge overcapacity, particularly in China. What we're seeing at the moment is quite interesting because that market, and we'll look at it a bit more in a couple of slides' time, is in huge overcapacity. And a lot of the Chinese companies are now looking to invest outside of China. Now, it's very difficult for them to do that in the US in the current environment, but we do see and we do expect to see a lot more Chinese companies getting involved in the European market when it comes to cathode. And that's really important because, that's where your refined lithium product is sent. On the battery side, again, oversupply, overcapacity. When it comes to that sector, we don't see that changing until probably the end of this decade on a global basis. That doesn't mean that the projects that you have going up in Europe and North America are going to fail. If they can produce batteries, we think these will be successful. And the important distinction to make there is pretty much all of the battery plants in Europe and North America have already contracted their batteries. If they can produce them, they've already sold them. They're on contract. So the market outside of China there on the battery side is actually in quite a better position than the market in China, where you've got this huge oversupply and batteries that can't find a home. I'm sure a few of you mentioned, sort of thinking, what about Northvolt? Why did that fail? Well, it hasn't completely failed yet, but that's really just a production problem. The market is there for their batteries. If they could produce the batteries, they could sell the batteries, and they have sold the batteries. They have contracts if they can produce the batteries to spec. That's a technological issue. It's not a market issue. With the battery plants going up in North America and Europe, if they can produce, the market is there, the contracts are there, and that means the supply chain for lithium going into Europe and North America is still there. On the OEM side, obviously, there's quite a few challenges when it comes to Chinese competition. I think it's pretty clear at the moment that both European and North American OEMs have successfully lobbied their governments to slow down the transition to electric vehicles and to put up trade barriers, because effectively any kind of EV mandate, which is now banned in the US, was favouring Chinese industry too much. So a little bit of breathing room for the OEMs, but they still have quite a challenge on their hands in the long term. Jose, did you want to add anything on there?
No, just to mention that with that asymmetry or a more, I would say, more a higher attractiveness on both poles, on both ends, it's pretty clear that today, if you're a refining company, I would do my best effort strategically to team up or to integrate with an extraction facility, but only between those two sectors that have many synergies, and especially to share the cost, the opportunities, to present a common front proposal to the cathode manufacturer, the cell producer, and the OEM. In today's market, it is the OEM who takes the decision in terms of procurement, in terms of quality, in terms of logistics, and most important, in terms of payments. And then again, on the OEM side, we're gonna see how the ownership of the Western supply chain is evolving, but we all know that there's a big incentive due to this, I would say, gap in margins in the midstream for Asian companies to integrate upstream and start getting control of the extraction, the refining, etc.
Yeah, it's an excellent point, Jose. And it's worth mentioning that what we're seeing at the moment with the sort of squeeze on the supply chain, and we've got this slide here on the big squeeze that's happening with margins. Um, it's very difficult to get financing for a cathode plant or a lithium refinery or even a battery plant when margins are basically zero. So a lot of the Chinese, just to stay open, will sell at effectively zero gross margin across the supply chain. And if you want to set up an asset with the risk and the return is, basically nothing at today's prices, it's very difficult to do. And that's why we're seeing a lot of the European and North American refinery projects not really moving forward at the moment. Likewise, the cathode side is under a huge amount of pressure, and very important because there's no point having a lithium asset and lithium refinery if you there for sort of national security reasons or sort of domestic supply chain reasons, if you then have to ship that material to China to produce into a cathode and send back. And I think one of the huge issues that we have here is when you look at that cathode side, the sort of middle of the supply chain, they're not good investments at the moment. They're high risk investments when it comes to the technology. Will it work? Will it be competitive? And at the moment, the margins are very low. And what we've seen there when we look at the sort of four examples that we have, Johnson Matthey obviously pulled out completely a couple of years ago from the cathode space. Norfolk have pulled back because of their own issues. Umicore currently coming towards the end of a strategic review with a new CEO there. In my view, it's quite likely that they will also pull back from their cathode investments. If you're a CEO of a company that has many different business units, you have a fiduciary duty to invest in those that you're going to make a decent return. not those which make a very low return and are relatively high risk. So a bit of a risk there, I think, from the incumbents such as Umicore and BASF for the future of cathode processing. Again, I think that gap will probably be filled, but be filled by Chinese companies wanting to expand outside of that country. I'm going to pass over here to Jose to look a little bit more, look in a little bit more detail at what's happening in Europe and North America in terms of what we have in the pipeline and how much of demand that can fulfill.
Absolutely. Cheers, Andy. Well, first of all, greetings to our loyal audience and blessings to the entire industry. This slide is particularly unique. It's one of our new slides in the slide deck. And what we wanted to do is actually show not only the capacity on the Western lithium-ion battery supply chain, ergo North America and Europe, but more the capacities existing and in construction of both cathode and lithium-ion battery cells from the perspective of the ownership. Because since there has been a lot of talks and discussions and analysis based on the capacity, we said like it's better to frame the discussion based on what's happening underneath, what's underlying the dynamics, and what better than do it based on ownership. And this is a graphical matrix, or a matrix with graphs in it. And the way of reading this is just on the columns. You're going to find the links of the lithium-ion battery supply chain. On the left-hand side, cathode, on the right-hand side, lithium-ion battery cells. And on the horizontal, basically track, you're going to find North America first and Europe, right? So first of all is in red, we have depicted the Asian investments, Europe in light blue, and North America in green. And first of all, what first strikes us is the levels, the proportions. In the case of, for example, cathode in North America, just by standing in North America and looking both at cathode and lithium-ion batteries, the proportion of Asian investment is not that significant. There is a big share of Europeans and North American investments in this particular space, which obviously makes us think and makes us question everyone what's going to be the development of the cathode industry in North America due to experience, due to trespass of funding, and most important of all, due to the security of raw materials. Now, if we jump to the right-hand side in that second quadrant, if I'm not mistaken, you're going to find a high investment of Asian companies in the North American sector. This is by origin, obviously. You can see that at least the Asian companies are targeting heavily in North America on the cell manufacturing quadrant or subsector or whatever. If we go to Europe, the situation is a little bit different. I think that here in Europe, we are a bit more exposed to Asian investment, which could be it could be a risk in terms of security of supply, but it's also a blessing in terms of the learning curve. For the cathode industry, and just show the margins, the unattractive margins of the cathode industry, and obviously thinking of the unsuccessful experience of Northvolt withdrawing from that particular space. And remember Johnson Matthey as well, it's quite important the action and the presence of Asian companies in the cathode in Europe sector. But when we go to cell manufacturing in Europe, it's yet to be seen whether those small, I would say less than 50% of Asian percentages still hold, especially considering the presence of LG in Poland, the presence of CATL in both Germany and Hungary, and other players that are ramping up and expanding their projects in Eastern Europe. And this is something extremely important, going back to the big squeeze slide and thinking about progress. Most of the European cathode manufacturers today are putting on hold their expansion capacity. Huh? Andy? Well, now going to this slide, we did another exercise that our loyal customers can find in detail. And this is basically putting side by side demand, production, and the next step in the supply chain. In the first case, we start with mining, lithium mining. So you're going to see the demand of lithium mining surpassing by huge amounts the domestic lithium mining, which we have in Europe, not for battery uses, obviously. And then the lithium refining sector, or at least the announcements that we have in the market, is noticeable how little production of lithium mining we're going to have till 2030. Even if lithium refining is still more optimistic, both of them are not going to catch up with the lithium demand by the end of the decade. Huh? Similarly, in the case of cathode active materials, the demand for 2030 is going to surpass the PCAM production at both the CAM production. There is another problem that PCAM production, the precursor for cathode manufacturing, is lagging behind, is lower. And finally, on the battery cell manufacturing side of things, there is a little bit more of optimism in Europe. The announcements surpass both the cathode production, that's a blessing and a curse at the same time, and surpass the lithium-ion battery demand. But then again, one thing is expectations, and the other one is reality. And we're going to see that in the next slide. Yeah, this slide is quite dramatic in the sense that we split the same values as for the last slide in columns into the additional volumes, the progressive volumes that are today existing. So in gray, you're going to find the 2025 figures. Depicted in orange, the gap, basically what's needed between 2025 and 2020 and 2030. And this is a great analysis because we're finally being able to witness that the majority of the capacity announced should happen not only in only 5 years, in a very short period of time between 2025 and 2030, but the fact that that investment is happening under a low price environment with delays, with I would say scoping of the pre-feasibility studies, and finally a huge gap in terms of financing. So if we are quite strict and very candid about this situation, very cold analyzing the situation, I would say that the majority of those announced projects are not going to be sufficient to keep on with demand. Andy? Well, this is another opportunity to revise the Buyby Margins slide. This is extremely important for the new members of the audience that haven't seen this analysis. That's available for you anytime. Just contact Derek. We have analyzed in the past, I would say the past semester of 2024, the returns and the margins of the industry, and especially on the refining side. We can see how deficient have become in the with the sustaining drop of prices during 2023, which most likely in 2025 is going to bring red numbers on the even on some of the integrated players. Today, in the Australian market, basically there are only a few companies that are making money. And with a fixed price under the $10,000 per metric ton bar and increasing costs due to inflation, this panorama is looking worse and worse.
So let's go on and talk a little bit about what's going to happen to prices, both on the downside and the upside, and that's where a lot of the interest is. Normally at this stage, I would remind everybody that there is the Q&A function, but looking at the number of questions, I think we're going to struggle to answer them already. But I'll try and group them together as we get to the Q&A towards the end. The lithium price rainbow, something we've been using on our webinars for a couple of years now, and we are very much in the red zone pretty much at the moment. We're waiting for the market to rebalance. We've seen a delay in capex. We've seen a reduction or people trying to reduce their opex, and in a market which is still doubling in size every 5 or so years, this is not a good position to be in. We are way, way below the incentive price. The issue is, in a market that has relatively few players and, has gone from 20 producing assets a decade ago to over 100 producing assets, very difficult to balance supply and demand. We don't see it changing in the next year. We see it getting closer to changing in the next year. It's possible we will see, a bit of upside in pricing, but again, very difficult for non-integrated producers to be incentivized at today's pricing. And I think that's why one of the things we've been looking at this year is potentially seeing an increase in M&A activity, because valuations are very favorable in the market at the moment. Jose, any comments on that?
Not really. I think this is a situation that's not going to change again in 2025. So a little bit of updating, and both studying in terms of the additional capacity is needed, which is being depicted over here. We usually tend to publish cost curves, both in terms of projects and in terms of technology. That technological review and increase of cost during 2025 is going to be key. Another thing that's going to be key is the cost, in particular, of the new supply. This is extremely relevant for today, because what we're seeing is that, first of all, more and more, the most reliant players in the market for 2025 in terms of cost are going to be the traditional ones. SQM and Albemarle and Salada da Cama. So we're going back to basics. And in Australia, basically IGO, TLEA, and Albemarle from Greenbushes. A lot of the other projects, especially in Australia, are going to be delayed. And this is also important when analyzing low-grade concentrates, both from Africa and both from China, Chinese lepidolite. We have been gathering opinions from several experts that just guarantee us that there's very little lepidolite survivors left in China, and we're starting to believe that that is the case. If we go to the more global overall picture of the market on the left-hand side, on the right-hand side, you're going to see how much material hasn't been built. So going back to the basics, we have the existing brines, then stacked on top the existing spodumene producers. And then we get to the Chinese lepidolite, which again, as opposed to the message that several, I would say, optimistic voices in the industry sent a couple of years ago, is not the volumes that everyone expected. That doesn't mean that China doesn't have the supply reaction capacity in order to keep the prices low for 2025 and maybe 2026. But what's extremely surprising here is the amount of additional volumes that need to be pumped into the market before 2030.
Yeah.
And the immediate questions that arises is what's going to be the OpEx of that new supply? And I guarantee you it's not going to be low. It's not going to be, go ahead.
I was going to say, if there's one takeaway from today's webinar. Look at the the red rectangle there on the chart on the right hand side, because who's going to put their money in to that at today's pricing? As I said at the beginning, a lot of the supply that we need towards the end of this decade and even more by the middle of the next decade just isn't viable at today's pricing. Even if you have the recycling tonnage which comes on, which is the green side, and we suspect that will, you still have these huge deficits at today's pricing. So somebody needs to move to incentivize that new supply to the market. And as we'll look at just briefly in the next couple of slides, I'm going to move forward a little bit, Jose. For time, we'll look at the cost curve here, and you can see, effectively the rather sorry position the industry's in at the moment. Jose, do you want to give a relatively quick rundown on our new cost curves and methodologies?
Yeah, absolutely. So this is a brief take on the cost curve, which has been extremely well received by our customers. They call it a biblical product because they're using not only to understand more of their competitors, but also of the new supply that's coming online. It's a good tool to describe what's happening in the market. And in line with that, a couple of caveats for a couple of takeaways from the listeners that are exposing to this diagram for the first time. First of all, the convenience, although quite slow in constructing and ramping up of brine projects on the left-hand side. Then a very little representation of brine DLE, though we're gonna hook this graph with some of the things to monitor outside of China in a couple of slides. And the big question mark is nowadays not lepidolite. We're quite confident that there's not that much lepidolite surviving the market. The big question mark is what's happening with Australian players outside from, in terms of the financing and in terms of the expansions outside Grim Bushes. And obviously, just to mention that recycling of LFP, I forgot to mention that is mostly on hold at the moment. Yeah? If you can jump to, yeah, exactly this one. So trying to jumping to the last couple of slides of this webinar, trying to close a little bit and hooking with the 5 things to watch. Again, quoting Andy, this is going to be the year of M&A, so expect further movements of the industry. In addition to the Rio Tinto, we still believe that Rio Tinto caught the vast lithium industry by surprise. It was a counter-cyclical movement. We've talked vastly about this movement. However, things are yet to be seen in terms of the performance of Rio Tinto. They recently built a brand new entity to focus on Salar de Rincón. Don't forget that Salar de Rincón is a proprietary DLE technology, completely new to the industry as well. If the audience moves to Eramet today, especially in Centenario Ratones, are gonna bring a lot of useful information to the market in terms of how likely is to add DLE capacity globally. Yeah? Salar de Hombre Muerto, the old FMC, Live and Arcadium, now Rio Tinto facilities is half DLE. And then there are only limited supply of DLE in Qinghai and Tibet. So Centenario de Drones is becoming, I would say, one of the uh, new grandiose DLE projects in terms of capacity. 30 or 40,000 metric tons LCE coming from DLE are not neglectable. And that's going to be extremely important for the Chilean sector, which is today just focusing on DLE applications for solars. Then Argentinian reforms are extremely important. We foresee a lot of activity in Argentina. There are sales of projects at the moment. There are purchases in the pipeline. For the first time, Argentina has managed to keep inflation low, first of all. Then secondly, ending the fiscal year 2024 with a surplus. And most important of all, if you haven't heard of this, this is key. They put in place the RIGI scheme, RIGI, uh, for that involves tax incentives and the impulse of projects that are above $200 million. And to finish this slide, and I'll hand it to you, Andy, what's left basically? I would say the cost curve publication, which is extremely relevant for all the players in the sector, and finally the competitive players of SQM and Albemarle, and especially on the most competitive asset that there is, Salar de Atacama in Chile. Remember, finally, that the elections are around the corner. So there's going to be elections in Chile in November 2025, and most likely it's gonna spin from left wing to right wing, and it's yet to be seen. First of all, what's going to happen between the SQM and Codelco merger, if that ever going to see the light of day, and finally, what new measurements are going to be brought by the new administration. So with that, I hand it to you.
Thanks, Jose. Going to skip over the recycling one. We may come back to it on questions. Just before we go to the Q&A, I do want to highlight that on the 15th of May, we will be collaborating with SFA Oxford on a battery day, looking at the entire supply chain with some great speakers at an event in Oxford. So if you are in the UK and want to attend that, please feel free to reach out. And there will be a series of presentations there, which will also be available online. I'm sure if you are registered for this, we will also be in touch about that in the near future. So moving to the Q&A, I've been trying to group these questions together. The first ones are effectively, are Western OEMs willing to pay a premium for non-Chinese material? And the short answer to that is yes, they are. And indeed, they have been. Not in lithium, but in other materials such as manganese, such as graphite, where China has even more of an advantage. You are seeing minimum prices above the Chinese spot price being put into contracts. Now, the interesting thing about that is those price levels were supported. The OEMs could pay a premium for that because they would get it back in a subsidy, in particular in the US from the EV tax credits for not having Chinese material. Now, it looks like those EV tax credits will cease to exist probably around about May or June this year when the legislation is likely to go through. And that puts a bit of question mark in North America. But I think ultimately, the OEMs, well, those tax credits or the incentive for the OEM to have not Chinese material will remain. That's pretty clear from what we've seen, and I'll talk a little bit in the moment about the sort of unleashing American energy executive order that was put out and the impact on the market. But yeah, in short, when it comes to OEMs paying more for non-Chinese material, yes, they will, but that does need to be supported by legislation of one type or the other. Next question we're going to go through. is hard rock refining still viable in Europe? And I'll pass this one on to you, Jose. And the question goes on. Obviously, we've seen Aurora being, sort of broadly cancelled. There's about 30 refining projects in Europe. A lot of them aren't making a lot of progress over the past couple of years. Struggling to get supply, struggling to get offtakes. Jose, your view on the refining sector in Europe?
Yeah, absolutely. I guess that Europe must have been the largest destination with the largest density of refining projects, but only in paper. So, and the majority is not big secret that most of them are going bust, but the ones that obviously are integrated. I don't know if we are allowed to mention a bunch of them. Well, now that we jumped into the subject, AMG is a case of successful refining capacity built up in Europe, but however they are integrated with their spodumene deposit in Minas Gerais, in the south part of Minas Gerais. Companies like, for example, CMP or Halmec, they've been treating historically lithium carbonate technical grade out of South America and somewhat hard rock as well. It's no big surprise that they are treating hard rock or lithium carbonate technical grade from other latitudes at the moment. And basically a handful of projects that today are struggling between financing to lock the supply contracts to make them binding. But the majority of the European refinery industry is going to go bust.
And I think I can group a few of these questions together, which are basically looking at, what's the impact of the Trump administration. So, on day one, we had this Unleashing American Energy executive order that came out, primarily focused on fossil fuels and freeing up oil and gas drilling in the US. But also, perhaps surprisingly, it had a lot of mentions of critical minerals in there. It also, I think, sort of pointed to what the philosophical difference will be of the current administration versus the previous one in North America. Yeah, we're not going to have an EV mandate. It's going to be down to consumer choice. To be honest, that's not going to have a huge impact. The change in the Environmental Protection Agency targets, a year or so ago, was the big impact for EV production and therefore EV sales in North America. What is interesting is the focus on critical minerals and effectively, potentially speeding up permitting, reducing legal challenges to projects, and getting a few more sort of domestic mines up and running. Now, that sort of flies in the face of curtailing or at least pausing some of the funding from the Loan Program Office and the Department of Energy. I suspect what will happen is, that part of the Inflation Reduction Act will stay. It will be very difficult given the sums of money that are being distributed under the Inflation Reduction Act for industrial projects that part will get repealed. The majorities aren't large enough, and if you're a 2-year congressman in a district that's potentially getting $1 billion plus of investment, you're not going to vote against that, basically. So I think that will stay. It may be reworked. There may be a delay as they change personnel, but ultimately, our view is that the domestic US supply chain will continue to see quite generous government subsidies. That said, the EV tax credits probably gone, and our best guess is towards the end of May, early June on that basis. And then we've got good question here. How did lithium get into oversupply with year-on-year growth in EV sales and battery demand growth, etc.? Great question. And the simple fact is it's incredibly difficult to match supply and demand. As I said, you've gone from 20 odd producing assets a decade ago to over 100. Turns out, we probably need 95 not 100, but demand grows every year. It can, we don't know exactly how much it's going to grow every year, whereas supply takes sort of 10 years to plan, 10 years plus to plan. So it's incredibly difficult to have supply to match demand. We're in a period of the oversupply. It's probably going to be a sort of 3.5 year period of oversupply, not dissimilar to the 2.5 year period of oversupply that we had at the end of the 20 teens. So yeah, it will continue to be a volatile market that way in terms of matching supply and demand when you have such high demand growth. Question here. Can a battery cell factory easily retool from NCM to LFP if the electrodes are produced outside of the factory? Short answer to that is no. We have seen it happen a little bit, but it tends to be that new supply that comes on because the market's growing so much will just produce something else, and it doesn't make a huge amount of sense to stop a production line and then retool it in a market that's growing so much. So we don't see a lot of retooling and switching from NCM to LFP just because the market's growing so much. It is possible. Does it make economic sense? Probably not. Jose, I don't know if you had anything you wanted to add on that one.
No, the repurpose is a long story that the market and everyone is discarding. I would say it's easier to build a facility dedicated, devoted from scratch, especially in China. And proof of that is the enormous capacity that has been built in China of NCM. So Chinese are not becoming only experts in LFP, but also in NCM.
Another one for you, Jose. So thinking of potential new supply, what is your view on Chinese lepidolite and African-based production costs? Should we expect further production increases?
Yeah, we've been talking extensively about the cost in previous episodes. Unfortunately, we just deleted the technical C1 cost brackets. But if going to the right-hand side, definitely on the right-hand side of the curve, the most competitive lepidolite asset around was, according to our calculations, around 14,000 metric tons LCE. If automated and first of all slash subsidized in some of the cases, but most important of all, that with the existence of byproducts, tantalum, niobium, you can drop that cost to below $10,000 per metric ton. That's what make them survive today.
Will lithium operate like a normal market where low prices cure low prices as high cost producers curtail supply and there is a balancing of the market, or will integrated players such as CATL continue to operate assets with a cost above that of market pricing to maintain their downstream advantage? Does that prevent a rebalancing of the market? Good question. There are a few things that slow down the rebalancing of the market in lithium compared to other markets. The first one is just the amount of debt that's in the industry. So at any point, because the market's growing so quickly, you've got about sort of 60% of the industry isn't depreciated, and a lot of them have very high debt repayments because they're in their first years of production. So it's very difficult for them to cancel that production, and also near-term production where they've also taken that debt on already. They're going to start producing, even if they're producing at a small loss. And that's something we're seeing, and that is impacting the rebalancing of the market. Is the market going to be sort of subsidized by the downstream in the long run? I think probably not. It is a risk, and certainly some players will take a bit of a hit on lithium production if they're producing batteries or they're producing vehicles. But actually, that integrated supply is still a relatively small part of the market. So I think we're still going to see lithium maintaining its sort of market dynamics, and ultimately sort of pricing that isn't just a cost plus price within a supply chain. And it's worth pointing out, lithium isn't unique here. When we look at the amount of lithium that, say, let's look at China, for example. China produces 11, 12% of the world's lithium, refines 50, 60% of it. It's not dissimilar to what happens in copper, where they produce 8% and they refine 55%, or even in iron ore, where they produce about 10% and they, produce about sort of 60% of the world's steel. Yes, they will keep some high cost domestic supply, but not enough to sort of stop the market from developing in a normal manner. Thoughts on the three large unconventional projects in the USA, one for you, Jose, which have got financed and are moving forward with low cost, long term Department of Energy financed projects. So looking at Lithium Americas, Ioneer, and Energy Source Minerals, 80,000 tons combined. Jose, any comments on the North American projects?
Oh, that's a tricky question. This is very difficult to tackle because it involves a proper cost analysis with some funding that we are not certain whether that's going to continue or not. What we can tell you is that there are some interesting projects in the US, brine, geothermal brine with good good concentrations of lithium above. For example, there was another question on Qinghai Tibet brines. Some of the American geothermal projects, they have higher concentrations than there. And in refining as well, we might see with I would say the close collaboration that the Argentinian government is having with North America, a boom in the refining business from the North American side more than the European. That's my take. Huh?
I'm going to do two more questions from the list, and apologies we won't get through to all of them. We'll try and get back to people offline after this. Jose, another one for you as I find the final question. Lithium sulfate, what are we seeing there in terms of people potentially producing and or refining lithium sulfate as an intermediate?
Yeah, very briefly as an introduction, but I would love to hear your opinion as a former professional of the refining industry. There has been a lot of discussion on shipment of concentrate that in the end has 94% of waste. And through the carbonation and liming, you end up producing a huge amount of sodium sulfate, which you need to figure out what to do. In that respect, even for Australian producers, there's always been this project, I would say, or this alternative of building a calciner and a leaching facility in the country and shipping lithium sulfate. At the moment, it hasn't, I would say, it hasn't transpassed paper. It hasn't been built. I'm not very sure if Pilbara and POSCO is doing that, or Pilbara and Ganfeng probably. They were building a similar project in close to Port Hedland in Australia, but with the prices at the moment, I don't know if that's making any further progress. Huh? But it all comes, in my opinion, it all comes to the level of waste that you're transporting.
Final questions, or indeed topics, and I'll put them together. Couple of people asking about the impact of oil field brines, and obviously we had an announcement this week that Saudi Aramco is looking into oil field brines now. Huge amount of brine, obviously, in the kingdom there, and then also questions over direct lithium extraction. So Before passing over to you, Jose, on DLE and our sort of current thoughts on commercialization, what I would say on the oil field brine side is yes, it's great to have these well capitalized companies in the market, but my view is that they're actually more opportunistic. They have these assets, they're looking at whether they can make money from them rather than going sort of all in on lithium. And indeed, if every oil field brine project got built and financed and moved forward, as of today, it still wouldn't make up more than 10% of supply in sort of 5 or 6 years' time. So, it's not necessarily the game changer that you think. The bigger game changer is actually Rio Tinto's purchase of Arcadium. They are now the most capitalized, or assuming it goes through, the most capitalized lithium player who is focused on lithium. They've gone out and they've bought assets, spent billions of dollars to produce lithium to become a big player in lithium. The oil and gas guys, I think it's still a bit more of a sideshow for them, a bit more opportunistic, and sort of testing the water or testing the brine, as it may be. Jose, final thoughts on direct lithium extraction?
Oh well, I think it's well known that I'm not a big believer in DLE, despite despite having a lot of quite serious DLE companies in the market and well financed. We have worked for several of those. However, whenever we go back to the volumes in our forecast and large database, the volumes are quite insignificant if you end up comparing them to conventional evaporation. And at the same time, it has a lot of drawbacks. A lot of people don't think that, a lot of people do think that it's the silver bullet, but you have to analyze that seriously in terms of sustainability, but real sustainability, like CO2 emissions, water use, energy intensity, and especially water use. That's where DLE gets tested. And it's worth to mention that the majority of the big players in the market, they don't truly believe in DLE. They do it because they are between a rock and a hard case and they're obliged by government guidelines. But very soon those government guidelines are going to be proven to be wrong.
Great. Well, with that and with a very strange shadow coming over my face from the sun, thank you all for the questions. And we will try and get back to more of them offline. But yeah, feel free to email and reach out to us should you wish to learn more about SC Insights and the work that we do, or indeed the upcoming event in Oxford in May. And with that, thank you all and goodbye.